So if we take one issuer, in this case the Government of Canada, we're describing what short-term interest rates are over a period of time from 3 months to 30 years. So short-term to long-term. And we're just describing yield, which is the market yield, not the coupon, but what the yield is on the bond, which is really just the interest rate as a percentage of the price of the bond at that time. The important thing is to see, for us, in analyzing what's going on in the marketplace, both from an economic and a fixed income standpoint, is what the shape of the yield curve is, and then how it moves. So this is the bond curve, the yield curve, June 2007. What this says to us is short-term rates are the same as long-term rates. As an economist, I look at this and say, this means the economy is going to slow down. And the reason is we had an asset bubble. So central banks can only control, and I'll get into this a little more later, only used to control what was going on in the economy by controlling short-term rates. So what they do is they raise these rates when inflation looks like it's going to be a problem. So this is what we call a flat yield curve. What it does is it takes away the ability, very simplistically, but it's important, the ability of banks to lend money, or borrow it from us as depositors and pay us here and then lend it out at longer rates to mortgage holders. There's an incentive to do that. The way the central bankers shut down the economy or slow it down is they say, nope, you're not going to get that anymore. We're going to decrease the incentive to financial institutions to lend out money. So the important thing, what did I say? Shape, this is flat, and shift. How does it move? And you can read this. It is in the Globe and Mail every day. You can follow the Government of Canada bond curve, yield curve, and it is influential to what goes on in our capital markets. So what's happened? This is the first quarter of 2009, just before the market started to turn up, after all of the turmoil. So what did central bankers do? In Canada specifically, in the face of market turmoil and economic turmoil, they lowered short-term rates. Because this now says, banks can pay depositors almost nothing, and lend out here and make a spread. It's a no-brainer. Banks make money that way. So what it says is, this is an upward sloping yield curve, which from an economic standpoint says it's poised for recovery. It's intended to recover. The key thing here is that at this end of the curve, the rates did not drop as much. So we didn't see a shift of this curve down, the whole thing moving down. We just saw the shape of it change. So when you hear about shape of yield curve, this is an important understanding to look at what the slope is. So what's happened since 2009? Where are we today? Almost in the same place. So what it's saying is that central bankers are still very concerned about the economy. They're keeping short-term rates lower in order to induce more economic activity by inducing more lending into it, more liquidity into that marketplace. And this has a profound impact because of what may happen next. And that is, if we know that there isn't a lot more room for interest rates to move on the downside, the difference will be, and this is what we're watching very closely, and also the managers of the bond pools and bond funds that we have, is what happens to this yield curve. If it moves up like this, again, it's a very different scenario than if the whole thing starts to move up, if it shifts up in parallel. Because if it shifts up in parallel, these rates could go significantly higher, which has an impact on the prices of long-term bonds. So when a bond manager is looking at the pools, and this is done for you daily in the pools and the funds that we have, they're looking at positioning along this yield curve and holding investments there in order to optimize the return and the risk in fixed income. So the key understanding here is this is an important part of every investor's portfolio. Whether you hold fixed income or not, it will influence what's going on in the economy. It will help answer the question, is this a sustainable recovery? And what we're watching for is, what's the shape and what's the shift like in on a trend basis for the yield curve? Now, I've also included here a look at oil prices as they compare to the TSX composite index. And the real thing to look at here is how closely they parallel each other. This gap is large. This is June 2008. But the real thing to look at is there's a high correlation between oil price and the TSX composite because there's a high component of the TSX made up of energy and materials. So this shouldn't surprise you, but it also tells us we watch this very carefully because we know we're going to be Canadian investors and we want to make sure that we've got an appropriate exposure to these kinds of markets, that it's not overweighting energy and materials. We also watch what's going on with gold prices, and again here, what I've shown you is a 200-day moving average against the short-term or the spot gold price. So this is as of October 12th, and it's just over $1,300, $1,327 I think last week. So what you can see is gold is rising over time, and you could argue by this measure of valuation, looking at the 200-day moving average, you could argue it's overvalued. Now, I'm kind of a gold skeptic. I don't think it's tied to anything. I think it's a safe haven. I think it's a good place for people whose behavior or behavioral approach says, I don't know what to do. Gold is a place to land. It may have been 30 years ago or 40 years ago, before the U.S. went off the gold standard, that might have been more of a safe haven. It's not as much today. But still, we will see that. It's not a supply and demand issue, I guess is what I'm trying to say. It's more of a sentiment issue that's going to influence gold price. Very difficult to forecast. We have exposure in our portfolios because we're invested in Canada. We look at the U.S., this is always a contentious issue because we're watching it every day too. This goes back to 1999, and this is the Canadian dollar versus the U.S. dollar. So this just shows you the appreciation, but it also shows you again the 200-day moving average to give you an idea of valuation. That's a way to look at where are we today and what does the trend look like. So right now this looks like, since the beginning of 2009 or mid-2009, a relatively steady trend. You're going to get things like the dollar pops up, or sort of drops right after the announcement yesterday about interest rates, and then pops up again. There's so many factors that are going to influence it. And in fact, in this monetary policy report, the Bank of Canada talks about that one of the risks to their understanding about how to project economic growth in Canada over the next 2 years, one of the risks is what happens to the dollar exchange rate. And they're not about to forecast it. They'll report it, but not forecast it. So how does this affect investments? Well, we've got this in your package. Not expecting you to read this one off the slide, but it's in your package to let you know what the returns are in some of the investments that we have placed for you. Behind all of these numbers and the names, we have 19 different investment managers working. So we employ investment managers as sub-advisors. We hire them and we fire them. My colleague Craig Maddock is here today. That's his primary focus, is looking at those managers, doing due diligence on those managers, and making sure that they're meeting our performance requirements. And if they don't, we can move them out of those portfolios. And in fact, we have, over the last year, done that a number of times in order to improve the outcome. That's our intention, is to improve the outcome of every one of the funds and pools that we're managing. So this gives you an idea. You can read it in your package. Glad to answer questions afterwards if you'd like about where we are with these investments. But this one I draw your attention to as being critical to an overall investment approach. This is a strategic asset allocation structure for two different portfolios that we're advocating right now. A 7.5-year portfolio, just as a target, so the time horizon 7.5, and a 20-year portfolio. And what this shows is the structure of portfolios that we'll recommend for clients who have time horizons of those different periods. So what's the real message here? Is that over shorter time horizons, we're advocating more fixed income than over longer time horizons, because on a risk-adjusted basis, it makes more sense to take on more risk, which is the equity market, to try and get more return if you've got more time in order to allow that to happen.